This is a case of a company being really convicted about where to invest organically and where to invest inorganically. It's just a really smart deal that SPS did. Their corporate development team, their CEO made a really good call here. Welcome back to the Inorganic podcast. My name's Christian Hassold. I'm your host, and this is episode 17. I'm coming to you from my mobile podcast studio on Nantucket, Mass. I'm hanging out with some family and enjoying the last couple of weeks of the August holiday. So my vacation digs are on, but I was really excited to run through this episode because a very interesting acquisition happened earlier this month. It was highly unusual in a couple of ways. And the feedback that I received from listeners from my last podcast was that you really like it when we talk about deals. So we're going to actually do a deal teardown in this episode, which is a little bit of innovating. If this is received well, we'll probably do some more deal teardowns. So let's get right into it. This podcast is going to be about the SPS Commerce acquisition of SupplyPike, and we can start with the teardown with the press release itself. On August 1st, SPS Commerce announced the acquisition of SupplyPike for $206 million. That deal was reported as structured as $119 million in cash and $87 million in SPS Commerce stock. So if you hear these numbers, you're thinking, wow, that's a lot. What kind of a deal was it for the company? Was it a good deal multiple, or what did it look like? I love publicly announced transactions because when there are these kinds of size deals, they have to disclose information, and that information helps us glean a little bit of detail around the transaction itself. So the first thing that they share in the press release is that SPS Commerce is going to recognize about $8 million in revenue from this purchase for the fiscal year 2024. And that number is important because it helps us roughly size up the size of SupplyPike at the time of acquisition. If they're getting about $8 million in revenue starting on August 1st through December, then you can probably double that and get to about $16 to $18 million in ARR, possibly as much as $20 million in ARR for their fiscal 2024 ARR. Remember, when a public company accounts for revenue, it does it on revenue, not ARR. And revenue trails ARR by usually 15, sometimes 20%. It depends. And so in this case, what we're understanding from this is SupplyPike at the time of acquisition was roughly 18 million in ARR, which means that 206 million purchase price is at least 10x the ARR of the company. Now, to give you context on that multiple, that is a really big deal multiple. If you look at Altimeter and Clouded Judgment, where they're reporting on SaaS valuations and multiples, we're seeing multiples in market on the low end of 3x and on the high end around 7 to 8x. So for SPS Commerce to pay 10x for this company, it might have a lot of interesting features like growth and also be particularly strategic to SPS's charter and mission. So there had to be some really strategic reasons why they paid up for this purchase price. There's also one other element of this transaction that everyone should know, which is this was a banker-run process. A banker-run process is when the company says, hey, we're interested in selling, and we want someone to help package up the company story and get the right strategic buyers to the table and give their best and final bids. And then the company decides which deal they're going to like. A lot of times in these banker-run processes, if the company is really interesting, then there's going to be a little bit of bidding going on. Sometimes the bidding is on the headline price, and sometimes the bidding is on the consideration and some of the underlying terms. My guess in this deal, there was a combination of both because, again, the size of the deal, the size of the multiple. Not all bank-run processes work out this way. Some stall and don't work out, and some end up more in sort of the expected range of 5 to 7x. The deal was run by Christian Clifford of Raymond James. He's a Boston-based banker, very well respected in the software space. And so great to see him and his team also getting a win from this transaction. So now that we understand a little bit of the high level of this deal, let's take a look at both of the companies. I think it's important to understand who is SPS Commerce and who is SupplyPike. So let's start with SPS. As I mentioned before, they're a public company traded on the NASDAQ. The stock is anywhere between $195 and $200 a share as of current, with a $7 billion market valuation. SPS Commerce business historically has been as essentially a trading network and also an integrator. So as a trading network, what that means is they sit between buyers and sellers and help them facilitate commerce in traditional terms. So for example, they help facilitate EDI transactions between a buyer and a seller, whereby the buyer says, I want 100 widgets for $2 each. And they use an EDI transaction to sort of communicate the order and to communicate the order acknowledgement, and then to say the order has been shipped, and so on and so forth. So they're traditionally in this sort of order transaction facilitating space, and they have a very broad customer base. They have big enterprise customers like a Coca-Cola as an example, and they may have smaller customers like, Christian's eyeglass case company. Like they really service the entire spectrum of customers of material size, and they help make those transactions go more smoothly. They also do a lot of onboarding and integrating. They help companies connect systems, especially like ERP systems to say Amazon or eBay. So they're kind of in that really cool part of the tech ecosystem whereby they do a lot of integrating between different systems to help facilitate commerce. So that is SPS Commerce business. Now, a couple more things to know about SPS Commerce are kind of important facts. Number one is their last quarterly report, they indicated they had about $270 million in cash on balance sheet. So they used $119 million in cash for this purchase. And I sincerely doubt that they used debt for this transaction because debt is very expensive right now. So they took a material amount of cash off of balance sheet in order to do this deal. And it was also noted by the CFO and the CEO on the call that this is the largest deal that they have ever done, largest deal in terms of size and largest multiple that they'd ever done. So again, capitalizing that this must have been a pretty strategic deal for them. Another nugget of information is that SPS Commerce has been on an M&A tear since 2018. Over the last several years, they have spent $500 million acquiring 11 companies. You think about that, $500 million divided by 11, SupplyPike is $206 million of that $500 million. So they bet really big on this deal. They had a lot of belief that this company was going to be a material opportunity. One of the things that they shared on their conference call with investors is they estimated this would expand their TAM, their total market opportunity, by about $750 million, which is a pretty material expansion. So we're going to get into what SupplyPike does and what kind of opportunity this provides for SPS Commerce. But before I do that, one other interesting thing is SPS Commerce is not always this acquisitive. Before 2018, they'd only acquired 2 companies over a 10-year span of time. What had happened was somewhere in the 2017, 2018 timeframe, their stock was at like $20 a share. The company wasn't growing. And an activist investor got involved and basically said, look, you guys are going to change your game. That activist investor got a board seat and the company all of a sudden became acquisitive. And everybody has sort of different opinions about activist investors. But in this particular case, what happened to SPS Commerce was they grew from roughly $250 million in revenue to over $500 million revenue currently. I think with this deal, they'll probably be bordering on somewhere around $575 million in revenue over a very short period of time. And you think about the acquisitions they've made. They've spent $500 million on 11 acquisitions, and they've gone from 250 to $500 million in revenue. That's repeatable revenue. So that $500 million looks like it's been really well spent. It's a great deployment of inorganic to help grow a company. And notably, they're running at 10 to 15% net income. So they're throwing off cash while they're growing. So all super positive signs about SPS Commerce. So now let's turn the pages and talk a little bit about who SupplyPike was. SupplyPike was a Bentonville, Arkansas-based SaaS company. This is Walmart headquarters, and notably, there's a lot of cool tech companies that support the Walmart and general retail ecosystem around Rogers, Arkansas, and Bentonville. So this is one of those cool kind of companies that was built out of what I would call the retail tech ecosystem. And the company was led by Dan Sanker, who was their CEO and their founder. And Dan this company had been formed out of a previous company called KStack. So there's kind of a backstory to the company. I'm not going to get into it on this podcast, but Dan worked out to be a really fantastic operator. because he figured out how to get this company from 2018 to present into the right position to grow very fast on an organic basis and to position them for this sale. At the time of the sale, there was about 120 employees in SupplyPike. And what SupplyPike does is essentially help brands recover what are called chargebacks or deductions from a retailer. So let's say that you're a brand like Coca-Cola or Mondelez, and you're doing business with either Amazon or Walmart. Some portion of the transactions that you do with them will have some sort of a dispute. Walmart will say, you didn't send us the right product, or you didn't send us the whole order on time and in full, which is a term that they use, OTIF, in the retail industry. You didn't meet with our compliance requirements, and therefore we're going to charge you back. Some 10% of those chargebacks are considered to be errant. And the old way of fixing them was accountants essentially talking to one another and saying, you owe me $1 and here's why. And, there's paperwork flying around in terms of the companies trying to decide who owes who for what reason and what's all the backup. And the system was really so inefficient that a lot of these big companies said, you know what, I don't have time to worry about every single chargeback and deduction. I'm only going to focus on the largest, which left a lot of money on the table. So a company like SupplyPike came along and not only solved this problem for Amazon, but they solved it for Walmart. They've started doing it for Target and other retailers. And what it does for a vendor like a Coke or a Mondelez, it means that they can go after more and more of these deductions to capture more and more millions of dollars of chargebacks that they're experiencing in their trading relationships with these retailers. It's just a part of doing business. It's considered a cost of doing business. But in order to fend those deductions, they use software. SupplyPike is uniquely positioned as a company in that they were covering more and more retailers sequentially. And it was one of the few companies that not only was multi-retailer, but also had a solution for both enterprise brands like the Coca-Colas of the world, but also those really smaller suppliers that did maybe 5, 10, 20, $30 million in revenue with a Walmart. And Walmart's known to have thousands and thousands of small suppliers. You can imagine like Goop, the Gwyneth Paltrow company. I think it's probably been sold off, but that's an example company that would be a customer where they would ship a lot of stuff to Walmart and Walmart would say, yeah, you got that order wrong. We're going to charge you. They have like one person to deal with all of this paperwork. SupplyPike automated all of it. And so if you think about what I said about SPS Commerce's business, which is essentially being in the middle of a lot of transactions between suppliers and retailers, SupplyPike is essentially helping those suppliers do right by themselves financially in terms of making sure that if a deduction is right, then they pay for it. And if it's not, then they get to reclaim that deduction from the retailer. So going back to what SPS said on their conference call, they reported this as high customer overlap, highly complementary to their business, expanded the TAM. You can see all of the pieces coming together. The other piece from that press release that I didn't mention earlier that's interesting is when they reported the revenue for 2024 at what I estimate to be 16 to 18 million, in 2025, they're forecasting revenue to be 25 million, which suggests that on an ARR basis, SupplyPike is probably going to be around 27 or 28 million. So growing from like 18 to 20 million to 27 to 28 million, that is a high growth company. And that is probably one of the higher growth companies that SPS acquired. And it just showed the quality of the SupplyPike business and the opportunity that SPS Commerce was gaining through this acquisition. So now that I've laid out who is SPS, who is SupplyPike, why this deal, let's now talk a little bit about what this deal actually means for the investors, the founders, and the employee. So of course, the headline price is $206 million, but $40 million had been invested into the company by Noro Mosley and Frontier Growth and a couple of other investors. These are very common, well-known investors in commerce. And so they're going to get their 40 million back, which means if you take that 40 million out of the 206, you now have 166 million left. So now what happens with that $166 million? Well, essentially, the investors start reclaiming their pro rata portion. Again, I don't know the cap table dynamics of the company, so I'm not going to pontificate about that. What I can tell you is they probably got more than another 40 million back because they likely owned at least 80% of the company as a whole of shareholders. So they probably got at least double, maybe more of their money back. And the second thing to know is that usually the employee stock pool is anywhere from 10 to 15% of the total cap table. let's assume for this particular transaction that the employee pool, which includes the founder and CEO, was roughly around 10%. If it was 10%, that would mean 10% of 166 million or 16.6 million would be set aside for the common shareholders. And if you were an employee who were fully vested, then you would, and you say you had 0.1% of stock, you'd get $16,600 broken out as 57% being cash and the balance being in stock. Now, one note here is, depending on your individual tax treatment, you're going to have to pay taxes when this deal closes, and you're going to likely pay the taxes out of the cash because you don't really want to sell the stock right away, especially if it's good stock. You'll probably want to sit on it. So you'll have to pay taxes from the cash for both the cash and the stock consideration. So you probably are left over after $16,000 with something like $11,000 or $12,000. Which is not a bad outcome, but a lot of times people look at the headline price of 206 million and say, wow, the investors got a lot and I got a very little. This is one of the things that the acquirer pays a lot of attention to. What I would expect of an acquirer like SPS, and I'm not saying this is what they did, but was what I would expect is they would want to try and retain these employees with additional incentives. So they would probably give them some retention incentives for staying 1 or 2 years, especially more incentive if they were a key employee. And the second thing that we would see happen is they would bring them into their own stock grant program. A public company usually has restricted stock units or something like that they give to employees. And so not only is the employee going to get some from this deal, they're also going to be enticed to stay at SPS Commerce. And why would SPS Commerce do this? Well, when a big company buys a little SaaS company, there's a portion of people in that SaaS company who don't want to work in a big company or may just like the startup environment and want to go back. The company wants to do everything they can to retain employees for as long as possible so they can get that institutional knowledge and really understand, like, how do we run this business in the right way? How do we scale it across our company? So there's a number of different incentives and tools that are in the toolbox to help excite and keep employees engaged post-acquisition. So if you're thinking, hey, that $16,000 is like, okay, but everyone else got a lot more money. Well, yeah, that's kind of how it works. But also starting and running a company is really, really hard. So if a founder CEO gets 3 to 4%, which is millions of dollars, you can think about all the sleepless nights they had just trying to keep the business straight and make it run in the right way and get it to a point where it could be such a fantastic outcome. And one of the other things is, as I noted, this is like one of SPS Commerce's biggest deals. Everyone within SPS is probably super excited to have such a darling company in the commerce space within their 4 walls. So I'm sure there's just a lot of love being given to everybody who's been acquired, not only to just make them feel welcome, but also because it's a really exciting deal. This is a great deal for SPS Commerce. I guess I can tell you how enthusiastic I am about it because I keep just speaking so highly of it, but it's just a really smart deal that SPS did. I think their corporate development team, their CEO made a really good call here. So now what I want to do is just kind of back out a little bit from the details and say, like, what are the learnings from this whole deal overall? I think the first and most important learning is about the CEO and founder of SupplyPike himself, Dan Sanker. I know Dan Sanker, I'd say as an industry friend, I won't go as far as saying personally, I've spent a little bit of time with him. I haven't been able to talk to him since the acquisition, but I can tell you one thing about Dan is that he's a very level-headed and a very even-keeled CEO. And this is, a very remarkable outcome. It speaks to the importance of really principled and focused leadership. There's a lot of other things SupplyPike could have done. They could have decided they wanted to be a platform company and invested a lot of capital in trying to be a platform. They could have tried to be a lot of other things, but instead they just were very focused on, we are going to do deductions management for brands, and we're going to get as many retailers to rinse and repeat the same process. And that is what we're going to do. And that's how we're going to grow. And that company growing like it looks, according to the data we have, 80 or 100% year over year speaks volumes. The vast majority of enterprise SaaS companies in the current market are growing at 15 to 20% at most. Growing by 100%, a lot of the times people are thinking that you need to have a CEO that is, super creative and constantly innovating and coming up with all these brilliant ideas and throwing spaghetti at the walls and just trying to, entice the customer to buy things that may or may not be ready. What we're seeing is that doesn't work anymore in this market. Principled leadership and focus works in this market. That's one learning. The number 2 learning is about SPS. Public companies, even with a lot of cash on balance sheet, they struggle to innovate. They're just too large. They have to focus on their core competencies. And so when you look at what SPS was doing as a company, SupplyPike was a very natural fit. They could easily put $10 or $15 million in cash and set up a team somewhere to go build all this tech and do it themselves and be a copycat. But it'd take them 3 or 4 years if they were successful to get to SupplyPike's revenue scale. So this is a case of a company being really convicted about where to invest organically and where to invest inorganically. And like I said, this is the largest deal they've done. I think it was probably the most brilliant deal that SPS Commerce should have done. So we really learn a lot from the leadership lessons and the market lessons and how you can really run an inorganic play to the benefit of the growth of the company. Growing from 230 to 550 plus million in revenue over 5 or 6 year span of time for a company that is largely a legacy company that doesn't have a lot of new products coming out. That is brilliant management execution from an inorganic perspective. So with that, I hope this teardown on this deal was super helpful and some of my opinions at the end were appreciated. As always, I really enjoy you listening to my podcast and liking, subscribing, and sharing. So please continue to do that. With that, I'm going to let you go back to your day and I'm going to enjoy a few more of Nantucket beach days before I head back home. That's all for now. See you on the next episode of the Inorganic Podcast.